Greetings! Today, I'd like to dive into a fascinating topic: China's massive stash of foreign reserves and how it's been navigating some choppy economic waters, especially with the return of Donald Trump to the US presidency in 2025. Buckle up, because this is going to be a deep exploration of global economics, trade dynamics, and the ripple effects of policy decisions. Let's get started. First off, let's talk about China's position on the world stage when it comes to foreign reserves. Picture this: China is sitting on a mountain of cash foreign currency and assets that dwarfs what most other countries have in their vaults. We're talking trillions of dollars here, accumulated over years of smart economic moves. If I were to rank the top holders of foreign reserves globally, China would be at the top of the list, waving down at everyone else. Japan's got a decent pile, sure, and so do places like Switzerland, the US, and India. But here's the kicker: you'd have to combine the reserves of those four major players just to get close to what China's holding. That's how far ahead they are. Europe? Not even in the same league. This isn't just a flex, it's a testament to how China has positioned itself as an economic juggernaut. So, why does this matter? Well, those reserves are like a financial superpower for China. They give the country clout on the international stage, letting it flex its muscles in global markets and weather economic storms that would sink smaller economies. It's like having a giant savings account to fall back on when things get tough. And for years, China's been building this cushion thanks to its knack for selling more to the world than it buys, a concept we call a trade surplus. More on that in a bit. Now, let's fast forward to early 2025. On the 20th of January, Donald J. Trump kicked off his second term as US president, and let me tell you, it sent shockwaves through the global economy. Markets panicked, currencies wobbled, and leaders everywhere started sweating. Why? Because Trump came in with a renewed passion for what he calls America First. Policies think economic nationalism on steroids. One of his favorite tools? Tariffs. These are taxes slapped on imported goods, designed to make foreign products pricier and give US-made stuff a fighting chance. During his first term, he rolled out tariffs that hit China hard, and in 2025, he's back at it with even more gusto. Let's break this down. Imagine you're China, and you've been shipping boatloads of goods, everything from smartphones to sneakers to the US, raking in billions of dollars. In 2023, for example, the US bought over $448 billion worth of stuff from China, making it the second biggest source of US imports, just behind Mexico. Meanwhile, the US only sent about $148 billion worth of goods back to China that year. That gap where exports far outweigh imports as China's trade surplus with the US, and it's a big reason why those foreign reserves are so plump. China gets paid in US dollars for all those exports, and those dollars either get spent on imports, invested abroad, or tucked away into reserves. For decades, China's been choosing the tuck it away option more often than not. But here's where Trump's tariffs come in like a wrecking ball. By slapping taxes on Chinese goods, say 10% or even 25% on some items, she's making them more expensive for American buyers. If a $100 Chinese-made gadget now costs $125, US consumers might think twice and opt for something cheaper from elsewhere, or maybe even made in the US. That means fewer Chinese exports, which shrinks the trade surplus, and in theory, puts a dent in China's ability to pile up those precious US dollars. To illustrate this, let's rewind to Trump's first term. Back in 2018, he kicked off a trade war with China, hitting them with tariffs on a range of goods. The data tells an interesting story. Chinese exports to the US peaked at $538 billion in 2018, but after the tariffs kicked in, they dropped to $449 billion in 2019, and slid further to $432 billion by 2020. That's over $100 billion shaved off in just a couple of years. For some, that might not sound catastrophic, but for the workers and businesses in China relying on those exports, it was a gut punch. Jobs were lost, factories slowed down, and the trade surplus took a hit. Yet, and this is the twist: China's foreign reserves didn't collapse. You'd expect a big drop in exports to drain those reserves, right? But if we peek at the numbers, they barely budged. Between 2018 and 2020, there was a slight dip, but nothing like the nosedive people predicted. Why? Two big reasons. First, China's government got crafty. They tightened capital controls, basically locking the doors so money couldn't flee the country too easily, managed the value of their currency, the yuan, to keep it stable. When the trade war hit and the yuan started slipping, regulators stepped in with a firm hand to stop the bleeding. Second, China didn't just sit there sulking, they pivoted. While the US was busy taxing their goods, other markets like Southeast Asia, Africa, and parts of Europe kept buying Chinese products. These emerging economies needed affordable stuff to fuel their growth, and China was happy to oblige. Fast forward to 2025, and Trump's second term is shaping up to be a different beast. This time, he's not messing around with targeted tariffs, she's going all in. On the 4th of February, 2025, he rolled out a 10% tariff on all Chinese imports to the US. Then, on the 4th of March, he cranked it up to 20%. That's a blanket tax on everything China sends over, from tech gadgets to clothing. Compare that to 2018, when tariffs were more selective, hitting specific industries. This new approach is broader and bolder, and it's got economists buzzing about the potential fallout. So, what's the damage likely to be? Well, it's early days, the 14th of March, 2025. As I'm speaking to you, so the full effects haven't hit the data yet. But there's a report from the Economist Intelligence Unit that's making some educated guesses. They're projecting a 20% drop in Chinese exports to the US between 2025 and 2027. If we take 2020, Ford's export figure of $438 billion as a baseline, that could mean a decline of about $88 billion by 2027, bringing exports down to around $350 billion. That's a hefty chunk of change. The report also predicts China's GDP growth could take a hit, slowing by about 0.6% over the same period, with real GDP growth dropping from 4.6% in 2025 to 4.1% by 2027. Ouch. But hold on, China's not defenseless. They've got some tricks up their sleeve to soften the blow. For one, the yuan might depreciate, making Chinese goods cheaper abroad and offsetting some of the tariff pain. Plus, remember those capital controls from the last trade war? They could tighten those again to keep reserves intact. And here's the big one. China's been quietly reducing its reliance on the US market. Back in 2017, over 20% of China's total exports went to the US. By 2023, that share was down to 12.8%. That's a huge shift. China's been cozying up to other trading partners, think ASEAN countries, the European Union, and even Russia diversifying its export destinations so it's not so tethered to American demand. Let's zoom out for a second and think about what this all means. Trump's tariffs could absolutely squeeze China's trade surplus with the US, and that might nibble away at their foreign reserves over time. But it's not a death blow. Those reserves still in the trillions give China a buffer that most countries can only dream of. Plus, their economic playbook is adaptable. They've got domestic consumption growing, investments in tech and infrastructure, and a knack for finding new markets when old ones get prickly. Compare that to smaller economies that might crumble under similar pressure, and you see why China is still a heavyweight. Now, let's speculate a bit. What if Trump doesn't stop at 20%? What if he jacks tariffs up to 30% or 40% later in his term? Or what if other countries like the EU or Japan decide to follow his lead and pile on their own tariffs? That could complicate things for China, forcing them to lean harder on domestic growth or accelerate projects like the Belt and Road Initiative to lock in new trade routes. On the flip side, if China retaliates with its own tariffs or starts dumping US debt, they hold a ton of it, we could see a full-blown economic slugfest. The US consumer would feel it too. Higher prices on everything from TVs to toys, and global supply chains could get tangled up fast. Wrapping this up, China's foreign reserves are a colossal asset, built on years of trade surpluses and careful management. Trump's 2025 tariffs are a serious challenge. No doubt they'll likely dent exports and slow growth a bit. But China's not the same player it was in 2018. It's more resilient, less dependent on the US, and ready to pivot as needed. Will the reserves take a big hit? Maybe a scratch, but I wouldn't bet on a knockout. What do you think? Will China shrug this off, or are we underestimating the long-term impact? I'd love to hear your take. Thanks for sticking with me through this economic odyssey. Until next time, stay curious.